We all know how it goes. Markets go up, markets go down, and we're just along for the ride. You can't do anything about markets going down, but you can do something about the way you react. Your actions during a falling market are of paramount importance if you want to avoid losing money. How? Discipline, patience, and keeping it simple are crucial. In this video, we will explain how you can arm yourself against your own emotions and why so many investors end up losing money. Hi, and welcome to Finance for Fun. There are many reasons why investors may lose money. Some common ones include investing in risky or poorly performing assets, failing to adequately diversify their portfolio, and letting emotions like fear or greed influence their investment decisions. Additionally, many investors may not have the necessary knowledge or experience to make informed investment decisions, which can also lead to losses. Investing always involves taking a risk. There is a chance that you will lose money. It is therefore incredibly important to know how others lose money so that you can prevent yourself from making the same mistakes. Let us take a deep dive into 5 big reasons why investors lose money. Reason 1. Not knowing what it is you're buying. Not knowing what you're buying causes big problems. It is immensely important that you understand what it is you are buying. By understanding the nature of the assets you are buying and the risks and potential rewards they offer, you can make more informed decisions about whether they are a good fit for your investment goals and risk tolerance. This applies not only to stocks, but to all kinds of investments. Bitcoin is a good example. At the end of 2021, the price briefly stood at 50,000 euros. There was a big run on Bitcoin. Everyone wanted it. It was in the paper, on the news, and discussed in bars. But who really understands Bitcoin, both technologically and as an asset? We surely don't. There are a lot of people who have lost money investing in Bitcoin as a result. Never invest based on rumors and stock tips from others. Always do your own research. Make sure you understand the assets you are buying. This also helps you in being able to monitor their performance and make any necessary adjustments to your portfolio to ensure that it remains aligned with your investment goals. Mistake number 2. Trying to get rich quick. In the investing world, there is no such thing as free or quick money. If you perform an internet search, you will come across many articles and videos with titles like "You should buy this stock" or "I made 150% profit on X" or "Buy real estate to get rich." Never blindly take other people's advice. While these strategies might, and I mean might, work for some people, they are immensely risky, and there is a big chance that you will dig your own grave instead. It's likely you've also heard of terms like leverage trading and CFDs, or contracts for difference. These are risky financial products, and many people lose money on them for several reasons. One reason is that leverage and CFDs allow traders to control very large positions with relatively small amounts of capital. This means that these products amplify both gains and losses. This means that even small movements in the underlying asset can result in a large gain or loss for the trader. While amplifying your gains sounds great in theory, in practice, these products just means you are losing money faster. They also come with additional costs. Perhaps most important, these products can cause you to lose more money than what you initially invested. Avoid leverage and CFDs if you are not completely and fully aware of what exactly they are. Mistake number 3. Ignoring transaction and other costs. Many investors are familiar with the concept of compound interest. If you are not, you can check out our video on compounding and cost averaging from the link above or via the link in the description. When compounding, every little bit of money that you have now helps tremendously in the long run. Novice investors often pay little attention to the costs associated with investing. The first type of costs to watch is transaction costs. Transaction costs are the costs associated with buying or selling an investment. These costs can include brokerage fees, commissions, and other charges that are incurred when making a trade. Transaction costs can vary greatly depending on the type of investment and the broker or platform you are using, but they have a significant impact on the overall performance of your investment portfolio. It is important to consider transaction costs when making investment decisions, as they can eat into your potential returns and reduce your overall profitability. The more trades you perform, the more transaction costs you usually incur. It's also important to watch other types of costs while investing. For example, mutual funds often have hidden costs directly priced into their market price. Consider any taxes you must pay on potential dividends, and finally, be vigilant for any account, exchange, or other fees your broker is charging you. Let's take a look at an example. By minimizing transaction costs, you will maximize your long-term growth. It is helpful to look at these costs as a percentage of your total growth. If you look at wealth growing over 50 years at a rate of 5% per year, adding just 1% in costs per year quickly shows a major difference in total return. In our case, 37% over the total period. That's more than a third just from that 1% extra cost. Mistake number 4. Not diversifying your investments. Spreading your investments, also known as diversification, is an important concept in investing. It involves investing in a variety of different assets, such as stocks, bonds, and real estate, spread across multiple sectors, in order to reduce the overall risk of your investment portfolio. There are several reasons why diversification is important. First, it can help you protect your investments from the impact of any single event or market condition. For example, if you only invest in a single stock and that company experiences a downturn, because, for example, the demand for the product goes down, the value of your investment will likely decline as well. However, if you have a diverse portfolio, the loss from a single stock may be offset by gains in other areas, reducing the overall impact on your portfolio. Second, diversification can help to smooth out the ups and downs of the market, providing a more stable and consistent return over time. By investing in a variety of assets that may perform differently under different market conditions, you can reduce the volatility of your portfolio and increase the likelihood of achieving your investment goals. Again, let's take a look at an example. Imagine owning 2 stocks, one in a luxury goods manufacturer and one in a vegetable farm. Now, a recession hits. Consumer spending on luxury goods is gonna go down, but people will always need food, and as such the price for vegetables will rise as farms raise their asking price to cover their costs. Here we see that by owning a diverse set of assets, we have cancelled out the impact of market volatility. Mistake number 5. Letting your emotions guide your decisions. Emotions are beautiful. They make us unique. But when it comes to investing, emotions are often the driver of bad decisions that then lead to costly mistakes. Let's look at an example. Markets go up and down over time. For most people, it feels good to buy as the market is going up, and good to sell when the market is going down. But both behaviors lead to suboptimal investing performance. Selling your entire portfolio during a crash is the biggest mistake you can make. Take a look at these examples. In this scenario, we start watching the market at the beginning of the orange line. We get more and more confident as we see the market going up, and then, when we feel confident enough, we buy. But, as we see, we are actually buying at a point where the market is most expensive. The opposite situation also presents itself. We start watching the market or have just bought at the beginning of the orange line. As the market is going down, we slowly lose confidence in our purchase, and then, when the market is at its lowest, we sell. But this means we are selling way below the actual price of the asset. While this all seems like perfectly logical behavior, what you want to do to maximize your returns is the opposite. You want to buy when the market is at its cheapest and when confidence is lowest, and sell when confidence is highest and the prices are at its highest. Make sure you know how to deal with emotions in many different situations. Experience the emotion and analyze why it is happening to you. The stock market is a psychological competition. Buy good stocks and wait. Have patience. No one can predict the course of tomorrow or the day after. The odds that the price will go up in the long term are in your favor as long as you don't act rashly on your emotions. In summary, keep things as simple as possible and only invest in things you understand. Avoid derivatives, buying on margin, investing with borrowed money, options, etc. Often, the investors with the simplest and most passive strategy make the best returns. Perfect! Who doesn't want to make money without doing anything for it? Studies have shown that the best performing group of investors simply ignore near-term price volatility, doing nothing and letting their investments compound over time. Unsurprisingly, this highest performing group of investors is none other than dead people. Thank you for watching our video. We hope that you have found this information useful and informative. If you did, consider liking the video and/or subscribing. This has been Finance for Fun. See you next time.